And if you'll identify yourself by name and your hometown, we'd appreciate it.
My name is Michael Mullen from Omaha. Would you comment on the use of derivatives? I noticed Dell Computer stock was off 2.5 points Friday with the loss in derivatives.
The question is about derivatives. We have in this room the author of the best thing you can read on that. There was an article in Fortune about a month ago or so by Carol Loomis on derivatives, and far and away is the best article that's been written. We also have some people in the room that do business in derivatives from Solomon, and it's a very broad subject. As we said last year, I think someone asked what might be the big financial story of the 90s, and we said we obviously don't know, but that if we had to pick a topic, that it could well be derivatives, because they lend themselves to the use of unusual amounts of leverage, and they're sometimes not completely understood by the people involved. And anytime you combine ignorance and borrowed money, you can get some pretty interesting consequences, and particularly when the numbers get big. And you've seen that, of course, recently with the recent Procter & Gamble announcement. Now, I don't know the details of the P&G derivatives, but I understand, at least from press, that what started out as interest rate swaps ended up with P&G writing puts on large quantities of U.S. and I think one other country's bonds. And anytime you go from selling soap to writing puts on bonds, you've made a big jump. And the ability to borrow enormous amounts of money, combined with the chance to get either very rich or very poor very quickly, has historically been a recipe for trouble at some point. And derivatives are not going to go away. They serve useful purposes and all of that, but I'm just saying that it has that potential. And we've seen a little bit of that. I can't think of anything that we've done that would... Do you think of anything we do that approaches derivatives, Charlie? Directly?
No.
No. I may have to cut him off if he talks too long. Is there anything you would like to add to your already extensive remarks? I'm sorry.
No.
Okay. In that case, we'll go to zone 2.
My name is Hugh Stevenson. I'm a shareholder from Atlanta. My question involves the company's investment in the stock of Cap Cities. It's been my understanding in the past that that was regarded as one of the 4, quote-unquote, permanent holdings of the company. So I was a little bit confused by the disposition of 1 million shares. Could you clarify that? Was my previous understanding incorrect, or has there been some change, or is there a third possibility?
Well, we have classified the Washington Post Company and Cap Cities and Geico and Coke in the category of permanent holdings. But in the case of 3 of those 4, the Washington Post Company, I don't know, maybe 7 or 8 years ago, Geico some years back, and now Cap Cities, we have participated in tenders where the company has repurchased shares. Now, the first 2, the Post and Geico, we participated proportionally. That was not feasible and incidentally not as attractive tax-wise anymore. The 1968 Tax Act changed the desirability of proportional redemptions of shares from our standpoint. That point has been missed by a lot of journalists in commenting on it, but it just so happens that the commentary that has been written has been obsolete in some cases by 6 or 7 years. But we did participate in the Cap Cities tender offer just as we did in the Post and Geico. We still are by far the largest shareholder of Cap Cities. We think it's a superbly run operation in a business that that looks a little tougher than it did 15 years ago, but looks a little bit better than it did 15 months ago. Charlie, you have anything on?
No.
He's thinking it over now, though, before. Zone 3.
Good morning. My name's Howard Bascom. I'm from Kansas City, and I've got a theoretical value question for you. If you were to buy a business and you bought it at its intrinsic value, what's the minimum after-tax free cash flow yield you'd need to get?
Well, your question is if we were buying all of a business and we were buying it at what we thought was intrinsic value, what was the minimum
Correct.
present earning power, or what the minimum discount rate of future streams?
No, what's the minimum current after-tax free cash flow yield you'd need to get?
We could conceivably buy a business. I don't think we would be likely to, but we could conceivably buy a business that had no current after-tax cash flow, but we would have to think it had a tremendous future. But we would not find, obviously, the current figures, particularly in the kind of businesses we buy, tend to be representative, we think, of what's going to happen in the future. But that would not necessarily have to be the case. You can argue, for example, in buying stock at a time when it was losing significant money. We didn't expect it to continue to lose significant money, but if we think the present value of the future earning power is attractive enough compared to the purchase price, we would not be overwhelmed by what the first year's figure would be. Charlie, you want to add to that?
Yeah, well, we don't care what we report in the first year or two of after buying anything.
Well, I would say that in a world of 7% long-term bond rates, that we would certainly want to think we were discounting future after-tax streams of cash at least a 10% rate. But that will depend on the certainty we feel about the business. The more certain that we feel about a business, the closer we're willing to play it. We have to feel pretty certain about any business before we're even interested at all. But there's still degrees of certainty. And if we thought we were getting a stream of cash over the next 30 years that we felt extremely certain about, we would use a discount rate that would be somewhat less than if it was one where we thought we might get some surprises in 5 or 10 years. The possibility existed. Charlie?
Nothing to add.
Okay. Zone 4.
Morris Spence from Omaha, Nebraska. You've made comments on several occasions about the intrinsic business value of the insurance operations. And in this year's report, you state that the insurance business possesses an intrinsic value that exceeds book value by a large amount, larger, in fact, than is the case at any other Berkshire business. I was wondering if you would explain in greater detail why you believe that to be true.
Well, it's very hard to quantify, as we've said many times in the report, but I think that it's clear that even taking fairly pessimistic assumptions, that the excess of intrinsic value over carrying value is higher by some margin for the insurance business. And I think that the table in the report that shows you what our cost of float has been over the years, and also what the trend of float has been over the years, unless you thought that table had no validity for the future, I think that table would tend to point you in the direction of saying the insurance business does have a very significant excess of intrinsic value over carrying value. Very hard number to put something on, and you don't want to extrapolate that table out, but I think that table shows that we started with maybe 20 million of float, and that we're up to something close to 3 billion of float, and that float has come to us at a cost that's extremely attractive on average over the years. And just to pick an example, last year, when we actually had an underwriting profit, the value of that float was something over $200 million. And that figure was a lot bigger than it was 10 years ago or 20 years ago. So that is a stream. Last year was unusually favorable, but that's a very significant stream of earnings, and it's one we feel we have reasonably good prospects in. So we feel very good about the insurance business. Okay.